Welcome to the world of real estate investment trusts, or REITs, a realm of investing that combines the potential for high returns with the tangibility of real estate. In the simplest terms, a REIT is a company that owns, operates, or finances income-generating real estate. They're a bit like mutual funds, but for properties. They allow anyone to invest in portfolios of large-scale properties the same way they invest in other industries, through the purchase of individual company stock. One of the key attractions of REITs is their potential for high dividends. By law, REITs must distribute at least 90% of their taxable income to shareholders annually in the form of dividends. This rule makes them a favored choice for income-focused investors. Moreover, REITs make real estate investing accessible to the everyday investor. You don't need to have deep pockets to invest in a skyscraper or a shopping mall. By buying shares of a REIT, you can own a piece of these high-value properties without the need for millions of dollars in capital or the headaches of property management. But REITs are not just about accessibility and high dividends. They also offer the benefits of diversification as they invest in a variety of real estate sectors, including commercial, residential, healthcare, and even data centers. This broad exposure can help mitigate risks and enhance potential returns. The purpose of this video is not just to give you a basic understanding of what REITs are, but to delve deeper. We'll discuss the importance of REITs in today's economy, advanced investment tactics, and provide a deep financial analysis. We'll also showcase some real-world case studies, debunk common myths, and answer frequently asked questions about REITs. So, buckle up as we delve into the intriguing world of REITs. In today's dynamic economic landscape, REITs hold a significant role. Let's take a moment to understand why. The current economic context is characterized by a low interest rate environment, which makes traditional savings and fixed income investments less attractive. This scenario has been driving investors to seek alternative investment options that can provide a higher yield. Enter REITs, real estate investment trusts. These investment vehicles offer a unique blend of benefits that make them a compelling choice in the current economy. REITs provide an opportunity to invest in real estate without the need to directly own, manage, or finance properties. They are traded on major stock exchanges, thus combining the liquidity of stocks with the tangible asset backing of real estate. Compared to direct real estate investments, REITs provide a more accessible and diversified exposure to the real estate market. They also offer the potential for higher returns, thanks to the professional management of the properties and the economies of scale that these companies can achieve. When we compare REITs to stocks and bonds, we find that they offer a unique set of advantages. Unlike stocks, REITs must distribute at least 90% of their taxable income as dividends to shareholders, resulting in a steady income stream for investors. And compared to bonds, REITs have the potential for capital appreciation in addition to the income they generate. Moreover, REITs can act as a hedge against inflation. As prices rise, so does the value of real estate, which can lead to higher rental income and, in turn, higher dividends for REIT shareholders. This feature makes REITs an attractive investment in an inflationary environment. However, like all investments, REITs come with their own set of risks, including market risk, interest rate risk, and specific risks related to the real estate market and the management of the REIT. Therefore, it's always important to do your own research or consult with a financial advisor before investing. As you can see, REITs offer a unique blend of benefits that make them a compelling investment choice in the current economy. Now that we've covered the basics, let's delve into some advanced tactics for investing in REITs. Firstly, let's talk about REIT selection. Choosing the right REIT requires careful evaluation of several factors. You'll want to consider the sector in which the REIT operates, whether it's retail, industrial, healthcare, or residential. Each has its own unique risks and opportunities. Also, don't forget to examine the REIT's financial performance, ideally over the past 5 to 10 years. Look at metrics like funds from operations, or FFO, dividend yield, and debt-to-equity ratio. Finally, assess the quality of the REIT's management team. Have they demonstrated a track record of sound decision-making and value creation? Next, we turn to portfolio diversification. Spreading your investments across multiple REITs can help reduce risk. You're not just diversifying among different companies, but also among different property types and geographic regions. This can help shield your portfolio from downturns in any one area. And remember, diversification doesn't mean simply adding more REITs to your portfolio. It's about choosing REITs that offer different risk and return characteristics to create a well-balanced investment mix. Lastly, let's discuss the power of dividend reinvestment. Most REITs distribute the majority of their profits as dividends. By reinvesting these dividends, you can buy more shares of the REIT, thereby increasing your ownership stake. Over time, this can significantly enhance your total returns. It's a classic case of letting your money work for you. These tactics, astute REIT selection, smart portfolio diversification, and disciplined dividend reinvestment, can all play a key role in your investment strategy. But remember, investing is not a one-size-fits-all endeavor. What works for one investor may not work for another. It's crucial to tailor your strategy to your own financial goals, risk tolerance, and investment horizon. Remember, a well-planned strategy can significantly enhance your REIT investment performance. To truly excel in REIT investing, one must understand the unique financial metrics used in this sector. Let's start with the Adjusted Funds from Operations, or AFFO for short. This is a more accurate measure of a REIT's performance than the standard net income. AFFO takes into account the unique aspects of a REIT, like depreciation and capital expenditures, giving you a clearer view of the cash flow. It's an essential tool for evaluating the financial health of a REIT and its ability to pay dividends. Next, we have the occupancy rate. This is the percentage of a property that is rented out. A high occupancy rate can indicate a desirable property in a good location. But remember, it's not just about the number, it's also about the quality of the tenants and the length of their leases. Long-term leases with reliable tenants can provide a steady income stream. Lastly, let's talk about leverage. This is the amount of debt a REIT has compared to its equity. A REIT with a high level of leverage may be riskier, but it can also provide higher returns if the properties appreciate in value. However, too much debt can be a red flag, especially in a rising interest rate environment. Keep in mind, these metrics are just part of the story. They should be used in conjunction with other factors, such as the REIT sector, management team, and macroeconomic conditions. And remember, while these metrics can provide valuable insight, they are not a guarantee of success. Always do your own due diligence. In the end, understanding these financial metrics is like having a compass in the world of REIT investing. They can guide you towards the most promising investments and help you avoid potential pitfalls. By mastering these financial metrics, you can make more informed investment decisions. Theory aside, let's see how REIT investing works in the real world with some case studies. Consider the story of a retail-focused REIT in the mid-2000s. It saw a boom due to the thriving retail market, but took a hit during the financial crisis. The strategic decision to diversify its portfolio post-crisis, venturing into mixed-use properties, saved it from downfall. The lesson here? The importance of diversification cannot be overstated. Next, let's look at a residential REIT that maintained a conservative leverage strategy, avoiding high-risk debts. When the housing market crashed, this REIT managed to stay afloat, proving that a prudent financial strategy can be a lifesaver in unpredictable markets. Lastly, consider a healthcare REIT that consistently reinvested its dividends. Over time, this compounded growth led to significant returns, demonstrating the power of dividend reinvestment. These cases illustrate the potential highs and lows of REIT investing, underlining the importance of a well-informed strategy. In the world of REIT investing, myths abound. Let's set the record straight. One prevalent myth is that REITs are an all-or-nothing investment. Not true. Just like other investment options, you can choose to invest as much or as little as you feel comfortable with in REITs. You're not obliged to put all your eggs in one basket. Another common misconception is that REITs are only for the wealthy. This couldn't be further from the truth. With the advent of fractional shares and low minimum investment requirements, REITs are now accessible to investors of all income levels. There's also a myth that REITs are inherently riskier than other types of investments. While it's true that all investments carry risk, it's misleading to label REITs as more dangerous. The risk associated with REITs, like any investment, largely depends on the specific REIT and the investor's overall portfolio strategy. As with any investment, it's crucial to separate fact from fiction when it comes to REITs. Now, let's tackle some of your burning questions about REITs. First up, what makes REITs attractive to investors? REITs offer a unique combination of income and growth potential. They provide a steady stream of income through dividends and the opportunity for capital appreciation as property values increase. Next, are REITs risky? Like any investment, REITs carry risk. However, the risk is often mitigated by the diversity of properties within a REIT and the fact that real estate tends to be a stable asset class. Then we have, do REITs perform well in a recession? This largely depends on the type of REIT. Some, like residential REITs, may be more resilient, while others, like retail REITs, could be more affected. Lastly, are REIT dividends taxed? REIT dividends are typically taxed as ordinary income, but there can be exceptions. Remember, there are no silly questions when it comes to investing. We've covered a lot of ground today in our exploration of REITs, from understanding their relevance in today's economy to delving into advanced investment tactics. We've dived deep into financial analysis specific to REITs, debunked common myths, and even addressed frequently asked questions. Remember, these insights are just the tip of the iceberg. The world of REITs is vast and dynamic, with a myriad of sectors, financial performances, and management styles to consider. It's crucial to conduct your own research or consult a professional to make informed investment decisions. As we forge ahead in our financial journey, diversification and smart reinvestment of dividends are significant steps towards building a robust portfolio. So, why not continue your learning with us? Subscribe to our channel for more enlightening content. It's time to empower yourself with knowledge and navigate the financial waters with confidence. Thank you for joining us today. Remember, the world of REITs is vast and dynamic, so keep learning, keep asking questions, and most importantly, keep investing wisely.